Hello, money and banking students. We are now in week 2, so good job with the forum discussion posts this past week. Really enjoyed reading them. It was good interaction with the class, so just keep plugging along with those. Again, this course moves quickly, so just remember to look through all the course requirements, stay on top of things, especially with the projects, and jump in early with those forum discussion posts, and that'll give you some time on the weekend to work on some other things. So this week, we look at reading chapters 5, 6, and 7. Feel free to look at those PowerPoints too to help you with summarizing the main ideas. But we're going to first look at money markets in chapter 5. By definition, money markets is any instrument that matures in 1 year or less. So this could be Fed funds, commercial paper, repurchase agreements that work in such a way that, say, an institution has $100 million to loan overnight or the weekend. They will require the person borrowing to put up some collateral. Well, we typically might be like $101 million in collateral. They call that a haircut in finance. That way, if they default on the loan, we know that because of bond and in prices and inverse relation interest rates, that $101 million could be less. So they do a little bit more to be on the safe side. And then you agree to repurchase those securities back with a stated given interest rates. And as we kind of stated last week, with the changes in the Federal Reserve tightening the money supply, short-term interest rates are going up. So that could be good if you are investing in CDs, you're someone that's retired, but it could also mean that the cost of your credit card payment is going up, or other types of payments that are tied to interest are going up too. So it's kind of a good and bad thing. It's good because the economy is growing and they want to put the brakes on before inflation kicks in. But if you're having to borrow, it's going to cost you more. But good thing now, our unemployment is relatively low, and hopefully the economy will keep growing at a good, decent rate. So with the money market section, you're going to learn a little bit more about how some of the prices are calculated, how interest rates are calculated. So you're going to dive into a little bit more detail now. Many years ago when I was younger, I was a Fed funds trader, so I start the day off with like $8 billion and have it sold by the end of the day. But my objective was always to do a little bit better than the market average for the Fed funds rate. If I was doing that, I was doing a good job. And I got to keep my job, because if I wasn't doing that, they would probably let me go because I want to do better than the average. So you're going to look at the bond markets. We talked about that a little bit last week, but now you're going to get really into more detail about the bond markets, particularly different types of bond securities out there. I want to just point out that the bond market is actually one of the biggest sources of ways that companies get money, even the government that gets money, through there's short-term treasury bills, but then there's notes that go up to 10 years and bonds that can go up to 30 years. So although it's not as sexy as the stock market, it is the largest form of way that we raise capital, and it's an important part in the financial markets. It's just not given the news as much as, say, the company news is out there sometimes, but even companies use a large amount of their finance through issued corporate bonds. So there's all kinds of different bonds that you're going to learn about. Some of them are tax-free in the form of municipals. Others you have to pay taxes on. So you're going to dive a little bit deeper in understanding those markets in that chapter and go through those readings. Finally, with the mortgage markets, the difference between what we think of like kind of as residential, but there's also commercial. But you're going to read a lot more about the characteristics in that market. Obviously, after the subprime crash or all the problems we had back in 2007, 2008, the textbook talked about last week in your readings, there's been some changes. So hopefully these changes and regulations have improved things, but there's also some concern right now, are some of those regulations going to be repealed? Because you're going to learn about, how there's the typical residential mortgage that banks might have, but then a lot of these mortgages are repackaged and sold as, say, a mortgage-backed security, a collateralized mortgage obligation. And that's what led to a lot of the crisis, was that a lot of these were built and there were different companies that created these credit default swaps, a derivative, to ensure against that they would not fail, just assuming that house prices would always go up. And that didn't happen. They went the opposite direction. And all these people that wrote these insurance contracts, credit default swaps, like said, well, there's no way we can cover all these losses, and that's what caused the crisis primarily. So, but yeah, you'll continue to read a lot more details and get a better understanding about this mortgage market, and then also, important thing I want you to walk away with too is just, how is a mortgage payment calculated too. So, well, that's it for this week. Do email me again if you have any questions. But as I said, jump in there early, get involved in the forum discussion post. I'll try to get the majority of you all, especially if it's earlier in the week that you post by the Wednesday deadline. But if I don't get to you, I'll get to you later too. So have a great week, and we'll talk to you online.